Picture this. It is 11 o'clock at night, and instead of sleeping, you are lying in bed doing math in your head. Not real math, anxious math. The kind where you try to remember roughly how much is in your retirement account, subtract what you think you will need, and land on a number that makes your stomach drop just a little. So you open your phone, because of course you do, and you start scrolling. Index funds, dividend stocks, real estate, someone in a polo shirt yelling about gold, someone else swearing that one specific strategy is the only thing that matters. 40 browser tabs later, you are more confused than when you started, somehow even more tired and no closer to an answer. That is most people. That is essentially the default condition of trying to plan for retirement right now. Too much information, not enough clarity, and a quiet, persistent fear that you are doing it wrong, or worse, doing nothing at all. A lot of time goes into thinking about money, not just how to accumulate it, but how people actually behave around it. Why some people retire calm and financially comfortable, while others who earn just as much retire anxious and underprepared. The difference tends to be less about the numbers than most people assume, and more about the strategy someone actually sticks with when things get uncomfortable. With that in mind, here is what today covers. More than 100 different retirement investment strategies were examined across books, academic papers, financial advisor frameworks, and first-hand accounts from people who lived through 2008 and 2020. From all of that, 5 emerged as genuinely worth your attention. Not the flashiest 5, not the 5 most likely to generate excitement on a forum. The 5 that actually hold up for real people with real jobs, real fears, and real timelines. By the end of this, you will have a clearer picture of which one fits your life. Start with the one nobody wants to hear about, because it sounds too simple to be taken seriously. The 3-fund portfolio. The idea, stripped all the way down, is this. You own 3 things. A total United States stock market index fund, a total international stock index fund, and a total bond market index fund. That is the entire portfolio. You choose a ratio based on your age and your comfort with risk. Something like 70% stocks and 30% bonds if you have decades ahead of you, shifting gradually more conservative as you approach retirement. Then you hold it. You rebalance once or twice a year. You do not trade. You do not sell in a panic when the market drops 12% in a single week. You simply sit there, almost frustratingly calm, while the portfolio grows because the global economy, over long enough stretches of time, tends to grow along with it. This strategy deserves serious attention for one specific reason. The person widely considered the greatest investor alive has essentially told his own family to use it. Not some elaborate hedge fund approach, not a complex rotation of positions, just low-cost index funds, primarily tracking the broad market. If that is the recommendation being left behind for the people he cares most about, it is worth considering whether simplicity is more powerful than it is given credit for. Here is the deeper reason this works so reliably. Most people do not lose money because they chose bad investments. They lose money because they chose reasonable investments and then panicked out of them at precisely the wrong moment. The 3-fund portfolio largely removes the thing that triggers panic. There is no single company that can collapse and take your retirement savings with it. There is no fund manager who might be quietly having a terrible decade. It is simply the market in its broadest form, doing what markets have done across a century of data, which is generally, not always, but generally, moving upward over time. The practical step here is almost deceptively simple. Open a brokerage account if you do not already have one. Select a total United States market fund, an international fund, and a bond fund. Most major providers offer nearly identical options with expense ratios below 0.1%. Set your allocation, automate your contributions, and then comes the part that actually requires discipline. Do nothing. Let it be boring. Boring, in this context, is not a limitation. It is the entire point. Strategy 1 handles the accumulation phase well. But a completely different challenge emerges once withdrawals begin, and most people are genuinely unprepared for how different that feels. Think of it this way. Saving for retirement is like filling a bathtub. The faucet runs year after year, and the water level rises steadily. Withdrawing in retirement is the opposite. The plug has been pulled, and the goal becomes making sure the water lasts long enough. That psychological shift from filling to draining affects people in ways nobody adequately warns them about, and it is where a great many well-constructed plans quietly come apart. This is where the bucket strategy becomes relevant, and it is the one that tends to bring the most clarity to retirement thinking, because it solves an emotional problem just as much as it solves a financial one. The idea is to divide retirement savings into 3 distinct buckets, rather than treating the portfolio as one undivided pool. The first bucket holds cash and cash equivalents, enough to cover 1 to 3 years of living expenses. This is the bucket that exists precisely for moments when the market drops and life still has to continue regardless. The second bucket holds more moderate assets, bonds and conservative funds, covering roughly years 4 through 10. The third bucket is the long-term growth bucket, primarily stocks, designed to keep compounding for a decade or more into the future. Here is why this structure matters so much in practice. When the market drops, and it always eventually does, withdrawals come from the cash bucket, not from the growth assets. The stocks in bucket 3 are left alone to recover. This sidesteps what is arguably the single most damaging thing that can happen to a retirement plan: being forced to sell growth assets at a loss simply to cover ordinary monthly expenses. The accounts of retirees who went through 2008 without this kind of structure are instructive. The common thread was a kind of paralysis, watching a portfolio fall 30 or 40% while still needing to pull money out of it every single month. The combination of market stress and forced withdrawals at the worst possible time is one of the most reliable ways a retirement plan fails, and the bucket strategy exists precisely to prevent it. It functions as an emotional buffer as much as a financial one. The takeaway here is a shift in the question worth asking. If retirement is within the next 10 years, stop asking only how much is in the account and start asking what is in the cash bucket for the next downturn. That reframe changes how financially secure a person actually feels, which in turn changes the quality of the decisions they make when conditions get difficult. The third strategy tends to get skipped more than almost anything else on this list, even though overlooking it may cost people more money than nearly any other mistake. Consider person 1, someone in their 50s with a solid income who maxed out their retirement contributions every single year with admirable discipline. The balance looked impressive on screen, but almost the entire amount was sitting in traditional pre-tax accounts, meaning every dollar withdrawn in retirement would be taxed as ordinary income. Person 1 had built a number that looked like wealth and then discovered that a substantial portion of it was never entirely theirs to begin with. Part of it belonged to future tax obligations they had never thought carefully about. This is the problem that Roth conversions are designed to address. The basic concept is straightforward. Money sitting in a pre-tax retirement account gets moved into a Roth account after paying the tax on it in the current year. From that point forward, it grows completely tax-free, and all future withdrawals come out without any tax owed. For higher earners who exceed the income limits for direct Roth contributions, there is a backdoor approach. After-tax dollars go into a traditional account, which is then converted to Roth. For people with certain employer plans that allow it, the mega backdoor version of this can funnel tens of thousands of additional dollars per year into Roth space through after-tax contributions made within a workplace retirement plan. Why does any of this matter enough to be on this list? Because tax diversification is just as important as investment diversification, and almost nobody frames it in those terms. When all retirement savings sit in pre-tax accounts, the implicit bet being made is that tax rates will be lower in retirement than they are now. That may well be true. But building an entire retirement plan around a single unknown variable like future tax policy, without any hedge against the alternative, is a risk most people are taking without realizing they have even made a choice. The strategic window for Roth conversions tends to open in lower income years, whether that is early in retirement before Social Security begins, during a career gap, or during a sabbatical. Converting portions of a traditional balance into Roth during those years means paying tax at a lower rate than would apply later. It is not dramatic, and it does require coordination with a tax professional, someone who understands the specifics of the individual situation well enough to make real recommendations. A general overview like this one cannot substitute for that conversation, and it genuinely should not try. But the core principle stands on its own and is worth internalizing. Do not just ask how much has been saved. Ask what kind of money it is. Pre-tax and Roth are not the same dollar, even when they display the same number on the screen.